Welcome to an Alternate Hue. I'm Hugh Anderson, and this is somewhat caught my attention recently. According to Reuters, Tesla programs its dashboards to exaggerate how far the vehicles can drive on a single charge and canceled service appointments for customers who noticed their car's range was shorter than expected. It's unclear if the faulty algorithms are still being used for range estimates, but the company has been flagged several times for lying about vehicles' range, including by the South Korean government, which fined Tesla $2.2 million earlier this year. They used to call this tampering with the odometer in my day. Now, a new survey reveals Americans are feeling significant economic pressure. That's not news. Only 28% feel financially secure. Gen Xers feel the most economically insecure, according to Bankrate. And the average adult says they need an annual salary of $233,000 to achieve such security. Regrettably, that's over 3 times more than the average $75,000 earnings of a full-time year-round worker in 2021. Now, living in the arid Southwest, I am very water aware, and Jesse Felder, a notable market commentator, lived in Central Oregon for over 20 years. During that period, the population grew significantly, but the area largely remained rural with a lot of land dedicated to farming. Perhaps the most noticeable trend during the span of time was the worsening of drought conditions, which had a major effect on the farmers in the area. But what he observed was that one of the most farming-dependent economies in the region decided to become ground zero for the boom in data centers. Meta and Apple have both opened multiple new data centers in Prineville, Oregon in recent years, even though they're massive consumers of resources like water and electricity. Now, these data centers simply take more and more groundwater, which is literally millions of liters per day, and farmers there have their water access shut off earlier and earlier in the growing season due to the worsening drought. I guess to paraphrase the dearly departed Marie Antoinette, let them eat data. Now, more fundamentally, the reliance on massive data centers highlights another fact that investors have so far paid little attention to. Big tech is in the process of transitioning from operating largely as an asset-light business model to a very capital-intensive one. Take a look at this. The bull case for many of the most popular technology stocks was the fact that they were able to penetrate or generate good cash flow without much in the way of capital invested in the business. Software as a service, for example, generates great profit margins, and incremental sales growth can occur without incurring much in the way of further costs. A major boom to the bottom line. Digital advertising is similar in these respects, and so long as they continue to grow, profits can grow even faster. Of course, there is only so much demand for software as a service in digital advertising, so when you reach its limits, profits are still good, but the opportunity for growth is gone. This is probably near the current situation for companies like Microsoft, Alphabet, and Meta, according to Felder. Microsoft and Alphabet have invested over $28 billion over the past 4 quarters. That is a fairly stunning statistic that demonstrates just how capital-intensive these businesses are now becoming. The artificial intelligence boom is another issue. In order to power many popular AI applications, thousands of the newest computer chips are needed. Most data centers, however, weren't built with these, and so companies either need to construct entirely new data centers or old ones need to be retrofitted. These increased costs don't immediately show up in earnings because companies don't expense all of this spending right away. They depreciate it over time. Alphabet decided recently to extend the depreciation schedule of its data centers this year. A little numerical sleight of hand that inflated its profits by $1 billion in the first quarter alone. You gotta love Wall Street accounting. And now for some in-the-weeds stock market analysis courtesy of Dave Rosenberg. And I repeat, and now for some in-the-weeds stock market analysis. Trying out new dentures for a friend. The gap between the 12-month forward earnings yield on the S&P 500 and the 10-year U.S. Treasury note has plunged to a 2-decade low. Now, this difference is called the equity risk premium. It basically helps decipher how expensive stocks are versus government bonds, which have lower volatility. The lower the premium, the lower of margin of safety in stocks. The last time the equity risk premium was lower than today was during, you guessed it, the dot-com bubble. And from that peak, the stock market dropped 49% over the next 2 years. So what are the possibilities going forward now? Well, Rosenberg Research ran a few scenarios. In order to revert to the two-decade average, interest rates on the 10-year Treasury note would need to drop to 1.5% from today's approximately 4.25%. or the stock market needs to drop to 3,000 on the S&P 500 from about 4,400. That's a slide of 35%. Talk amongst yourselves. Now those wacky Russians, the master of understatement. Under the headline, Russia's lunar lander crashes into the moon, comes the formal comment from the Russian Space Agency. The robotic Luna 25 spacecraft appeared to have, quote, ceased its existence, unquote. Kind of like how Evgeny Prigozhin's plane ceased to exist. At least he didn't fall out of a window. You gotta love him. So that's it for this week. I hope you enjoyed my little rant and roll on Tesla, Meta, Apple, and all the other darlings of modern society and the stock market. Until next time, I wish you all the best. Stay healthy, stay prosperous, and stay focused on the future.